Recording in progress.
Okay, guys. All right. So, if anybody has any questions along the way, just, make sure to ask me anything, because I know this market maker buy and sell model is quite difficult initially, but the reason why I'm sort of getting into these details, because this is very advanced topic, because I want to explain finally how to use this technique, and this is the only way. If you know about this, you will know how to use this. So that's why we could say I explained something that's more difficult at the moment. So let's continue. Actually, everything's clear right now, right? So nobody got any questions, I guess. If you have any questions, just write in the chat room and I will answer it. So just let's continue then. So we were at, this is the reaccumulation, and the final stage of this model would be something called the smart money reversal. So smart money reversal, that's the name of it. I usually just write, you can write SMR like that, or write it as smart money reversal. So this stage is the level where actual interbank and institutional, so the real institutional traders, not the fake ones. So this is where actually real selling, institutional selling comes in the market. So this is the level where actual institutional selling orders will arrive into the market. This level, the smart money reversal. And, at this point, they are building up buying positions. At this point, they will close all buying positions. They will accumulate sales. Then, sales take down the price. They need to make another pullback to accumulate more sales. Here, another one, add more sales here, and they are adding all of these pullbacks are giving them low risk opportunities to add more sales until the market takes down the price all the way below the original consolidation. So that's what you should expect. Once you have this idea, once this is happening and unfolding in the market, you should see the market trade below the original consolidation. We'll see what happens over time. It's quite possible that the market will take this out. Also, I actually got an analysis on higher time frame that we are heading way down. So I'm pretty sure this will play out well. So you guys can see it unfold and see that it actually works. So back to the smart money reversal. So once the market is in the reaccumulation stage, it will impulsively take out the reaccumulation and make the smart money reversal. Now, before I would zoom in here on the lower time frame, I want to add a little bit of context of the actual smart money reversal, how you can notice that this is actually happening. So a lot of times the smart money reversal would arrive into one or two standard deviations of the initial range. You guys already know about this, or it will fill in, let's say, a fair value gap. So it's That's the way you should imagine it. In this case, in this example, we actually had standard deviations in the market. And here on the lower time frame, we had this confirmation. So this is what the market offered on the lower time frame. It offered the no break of structure entry right there. And if that wouldn't be offered, then you would see either the second one with the breaker. So here, let's zoom in on the 15-minute. Let's see what happened here. So obviously we got this reaccumulation phase in the market where we will see mostly like an accumulation. And this stage, the smart money reversal, let's look at what the market did here. So it will be quite easy to notice that actually the market will start making an actual reversal from this point. So let's mark up everything as we would be in a regular day trade. So you start off with the time, the midnight, the Asia, also notice we had these highs. So we had this high. Imagine we have buy stops here. So a bunch of confluences are right there. So if this wasn't enough to have 1.5 standard deviation, or let's say one standard deviation aligning with 20, or let's say you could even use the 25, excuse me, 20. So let's see. See the difference in the sweep, right? So it's not too much, say 5 pips, but you get the idea. We have 20 pips sweep here. The market is meeting 1.5 standard deviation of the initial range. See that it's right there. And in this case, we had what? As I mentioned before, let's go back to the 4-hour. We can even have the standard deviations. We can or have sell stop sweep or buy stop, doesn't matter if it's the opposite direction, I don't care. Same thing, just opposite direction. or the market would fill in, let's say, a fair value gap. Just imagine this would be fair value gap in the market, and that's filling in with the smart money reversal. And you know, typically you wanna see typically an impulsive move, a strong impulsive move. This is what happened. In this case, actually, we haven't even had any news. I'm gonna tell you that we haven't had any news event in this case. So a lot of things are quite obvious that this is a engineered manipulation in the market. So this is engineered to be as perfect as it can be, because we haven't even had news. I remember this day, we haven't had any news, and this strong impulsive move happened. And notice that where does it stop? 1.5 standard deviation, aligning with 25 pip sweep right there. So that's quite relative, or you can even use the 20. But the 25, you know, it's also a very nice number, because you know, you have to consider in the sweeps like the pip amount of stop loss that most people use. Like what's the stop loss size that most people use? It's 15 pips, 20 pips, 25, 30, 35, 40, or 50, right? So it won't be 22.1, right? So it will be 20, 25, 30, stuff like that. So in this case, 25 was aligning with 1.5 standard deviation. It was right there. But you know, you do not want to catch the trade up here, so that wouldn't be your goal. Just, you know, in hindsight, I'm showing you what happened. And you know, once the market would, let's say, sweep this consolidation, you know, let's say it's sweeping this trend line, see that trend line liquidity that's going on too. Once it sweeps it with such an impulsive move, that's when this no break of structure entry could happen. As I said, you need an impulsive move in the market. You will see a pullback, then you see a retracement, and ta-da, this is what happens. The market arrives to optimal trade entry, you take the trade. And you know, once you have something like this, you have the standard deviation, you have the 25 or 20 pip sweep, you know that this is a clear sign of manipulation. This is a clear liquidity sweep, and it's a whole impulsive move. So you see a whole impulsive move. That's when the actual no break of structure entry works in the market. Let's go to the 5-minute. So now we are on the 5-minute time frame, and at this point, let's mark up a couple of things before I show you guys this entry. So if anybody remembers the kill zones, we had what? We had the London 1 o'clock, 5 o'clock, right? So it take a few seconds until I do this, but you will see why am I showing you once again the key zones. Because you know, almost everything is moving according to the time and price. So the price is moving according to time. So the price is engineered around the time in the market. So let's see. So what did I say about the entry? So a lot of times, I even showed a couple of examples earlier, that a lot of times the market would give the actual entry at what time? At 8 o'clock to 8:30, right? That's 8 o'clock. And that will be 8:30. See that? So we even got the 8 o'clock, 8:30 time window within the actual key zone. So we even narrowed it down to an 8 o'clock to 8:30. See that 8:30? It's exactly there, this part, 8:30. So we even narrowed it down. So after you seen all this, you've seen the impulsive, you've seen the market take out the trendline liquidity. We had the buy stops, 20, 25 pips sweep was aligning with 1.5 standard deviation of the range. And, obviously, we had all this consolidation down here, which the market will take out. So you have the bias that once you take this trade, this will be something that's a really high probability. So notice if you have the impulsive, see that? And that's where the market exactly at 8:30 it arrives to your entry. So in this case, once you see the impulsive and once you have the bias that actually this is a reversal, it's not some kind of you have a bias. I mean, this is a bias. You sweep a high with 25 pips, the market reacts this accurately to 1.5 standard deviation, and 8:30 is giving you the perfect entry, right? So 8:30 is right at optimal trade entry. So it just cannot be missed like that. So this is the actual execution of the no break of structure entry. So we do not have any break of structure. We only have an impulsive move, and we only have the market making a pullback, a retracement at 8:30. So that's how the no break of structure entry would actually play out. And in this case, you do not need any order blocks. Doesn't matter in this case. It's not that important. Just alone, if you use these standard deviations, and on the 1 hour, we had the ID of this market maker sell model, the original consolidation, the low risk buy, not the low risk buy, reaccumulation, then this would preferably be, you could anticipate that this would be up here, which I showed on the 5 minutes. This would be the actual smart money reversal in the market. But you would, let's say, still be unsure. Then once this happens, the market drops down, comes back up, offers another entry. Now that's when you could be pretty sure that this whole thing is a smart money reversal. Excuse me, not smart, it's a market maker sell model. And eventually you want to see the market trade below the original consolidation. And going back here, see, that's simple. So this is what you have to look out for. So obviously we had initially a bias, like let's say we had the bias of the market could reverse at the standard deviation. It was quite obvious that this impulsive was obviously a sweep of these highs, the trendline liquidity. So you need some sort of bias and you need some sort of narrative in order for this to work. Or this could be, let's say, a fair value gap. So this could be a fair value gap. So imagine that here on the left side, we would have filling a fair value gap from the left side. And you see something like this, the impulsive, the pullback, retracement, then that's a pretty clean trade right there. And like let's say here we also had, what's this? We had double bottoms, right? See that? Double bottom. So you even have so many confluences and IDs that eventually the market has to trade down. That's this 830. So you can get this wrong. 830 right there. So you must hold a bearish bias. See, this was also right. We had double bottoms. Just cannot get more simple right there. So this is introduction to the smart money reversal. So I know it was a lot of new information, I guess. ICT. He has a couple of contents about this, but I will be honest, I never seen any clean explanation myself. So it was kind of difficult to understand from those videos, but I use this a lot of times, and it works very well. So it's ICT stuff actually, and nice. Let's go back to 1 hour. I want to show you guys something. So the 1 hour. So let's go back to the 1 hour. All right. So let me delete a couple of stuff and show you this. So let's just. See this? We had actually also a breaker created. The market swept this high, came down. See that? And this became also a breaker. See, the market traded up to the breaker. You can even use that like that. This was the breaker. So the market traded later back up to the breaker. Also filled in a fair value gap there. So once the market created the smart money reversal stage, and you start seeing something unfold like that. So we have a breaker. You can be pretty sure that this will work out, because before on the left side we already had these. We had the original consolidation, low risk buy, reaccumulation, smart money reversal, and then the market came down to a breaker. See that? That's the breaker. It offered the sell, and then it's doing what? Another sell. Here we had this order block. It's offering another sell. It came back to the order block. And today I even saw Nico take this short. So I guess she was looking at the same thing, but see that? And this is what I tried to explain. So once this is completed, we're gonna have a low risk buy, another low risk buy, until we start moving above the original consolidation. And basically this is the same thing what you see here. We had the original consolidation coming all the way up here to the smart money reversal, and then we basically switch direction, and here we have the low risk sell. See that? Breaker, fair value gap right there. This one, order block, optimal trade entry right there. Not a perfect trade. And again, it's doing what? First an impulsive, see that? This is what I tried to explain with the impulsive thing. So this is how it moves. It's creating a consolidation, an impulsive, a consolidation, an impulsive, a consolidation, another impulsive. And sort of the same idea. It will not be always so clean. So I didn't even cherry pick this one. I just seen this and just wanted to show it. But here we have the consolidation, sort of the impulsive, now the consolidation, impulsive there, little consolidation there, impulsive, consolidation, the smart money reversal, and this is how the main idea and the cycle works. So the market maker buy and sell model. Yeah, probably the best explanation about it. But if anybody finds a better explanation, I'd be happy to see that. And going back to the smart money reversal, just do not forget actually, do not forget that we got two type of smart money reversal. So these patterns are meant to be here. So in this case, you guys seen the no break of structure entry. See that? So it's a real thing. So what I'm teaching is real. It happens in the market. And then the second one would be this. We have a breaker and the market arrives to that. And, same thing, just different pattern. But yeah. You know what, guys, let me show you another example of the no break of structure entry. Because there are quite a few ways to use this. Let's go to USD CAD. Okay, guys, look at this. So this actually is a monthly time frame, smart money. Smart money, no. Market maker buy model. On the weekly time frame, US dollar, Canadian yen, Canadian dollar, excuse me. See, this would be the original consolidation. This would be a low risk buy. Why is it a low risk buy? We had the consolidation, we had the impulsive, came back, consolidated, interbank traders were offered a low risk buy here. Another impulsive, the market comes back again, offers what? Optimal trade entry. See, same thing. So not the low risk buy. This could be called reaccumulation. The market started accumulating. Then smart money reversal. Down here, this is actually where the reversal happens. So again, here down there, we had the two patterns. I won't zoom in there, but on lower time frame, I will be pretty sure the same thing happened. So, okay, so interbank trader is actually the guys. It's actual the traders for the banks. So it's actual. So interbank traders, let's say Barclays trades FX, then they are interbank traders, right? So this is smart money reversal. Then we have what? This is low risk buy, another low risk buy. See that? So it's giving you optimal trade entries. And now that this is happening, see that? So now that this is happening, this pretty confident looking market maker buy model. So let me just take my time to mark this up. Eventually you want to see the market trade above the original consolidation. Now, if this would be kind of skeptical looking for you, Okay, Polona, yes. So when it's sell, it's low risk sell. When it's buy, it's low risk buy. So if accidentally I said this is a low risk buy, I'm sorry about this. This is a sell. So I'm also getting tired from too much speaking. But yes, this is a sell. So sorry about that. So if anybody thinks this would be something that wouldn't work out, then I will tell you that this will happen exactly like this. I don't care how long does it take, it will happen, and I can show you why it will happen. This high and this high are equal highs. I don't care it's off a little bit, but those are actual equal highs. So eventually the market will take this out. You can trust that. So yeah, we'll see what happens. But let's say this would be a 5-minute time frame, then you would be looking at the same thing. If it would be the 1 hour, you look at the same thing. And I guess this makes sense. We got the equal highs there. So, just I wanted to show another example of how I use this. But the reason why I came here, we got like 10 minutes left, so I'll be quick. So the reason why I came here to show another way of using the no break of structure entry. So if you notice what happened here in the market, we had this sort of order block candle, you could call it that. We also had actually this breaker, so this candle was a breaker actually. I'm just saying. So this is also a breaker. The reason why this is a breaker, because the market created a low, created a high, swept the low, so it's sweeping the sell stop, and then obviously market breaks that, and until this level is respected, it can come back here as many times as it wants to. Until it's respected, it will always work. So we even had the breaker. We had this OB. We also had optimal trade entry from this low to this high. This was optimal trade entry. I can even show you. So obviously quite a few confluences are right there. See that also optimal trade entry, but just additional confluence. But mostly the bias for me here was the breaker, and once the market is arriving to like an interesting area, and you have a bias that this would work out, and let's say we keep the optimal trade entry here. So if you keep this level there, so let's just keep this here, and you move down to the lower time frame, you should be able to see more confluences. So let's say we have trendline liquidity, right? So that's a trendline liquidity. Also, we have actually same thing, guys. So exactly the same thing. Original consolidation. So it happens so many times. That's the original consolidation. This is the low risk buy. This is the redistribution. And what's that? What's that? Smartman reversal rider. And it's the exact same thing that I just showed you. We have an impulsive move. The market makes a pullback, a retracement, optimal trade entry. See that? Same thing. And again, you can be pretty sure that this one is working again without any break of structure in the market. See, we only got the impulsive. Haven't got any break of structure, nothing. Only look at the confluences. We had the breaker, we had the order block, we had the higher time frame, optimal trade entry, right? So this was 62. We had also the 30-minute original consolidation. we had the low risk sell, we had the redistribution. And guys, actually, when we moving up, we have reaccumulation, and when we're moving down, we have redistribution. Actually, do not ask me why it's called this way. I'm just telling you what ICT told me. So this is a redistribution instead of reaccumulation, but the same thing basically, just you call it differently. So I don't know why, but it is what it is. And again, this is smart money reversal. Then look at what happened. We had low risk buy opportunity, right? So the market offered us the optimal trade entry. See that from that low to this high, came back, reacted. And also this was actually an order block right there. So let's delete this. So I hope you guys can see that. See, the second low risk buy was there. Then the next one, you would expect it to happen somewhere here until all the way we get above the original consolidation right there. So same thing, different pair. Again, I did not cherry pick this. I just came here randomly because I seen this in the morning. So that's why I'm showing you. And again, notice the smart money reversal. Same thing. We have no break of structure. We only have the impulsive. So we either have the impulsive, no break of structure, or we use the breaker. So that's how you would take the trade. Target above the original consolidation. Obviously, along the way, you could take partial hit. That's already 1 to 3. That's a 1 to 5. It's almost 1 to 10, 1 to 20, stuff like that. But you get the idea. So same thing here. We have consolidation, impulsive, consolidation, impulsive, consolidation, until we get to an interesting level. And again, which I said, yes, you can. It's fine. It doesn't matter what you call it. Like, we're talking about the same thing basically. As long as we understand each other, it's the same thing. But you get the idea. We have an impulsive. The market offers a sell. We have another impulsive, offers another sell. Then the market arrives to an interesting level. When I said interesting level for the smart money reversal, this is what I meant. So on higher time frame, you have this low to this high, optimal trade entry, and that's where the actual smart money reversal happens, right? So, trendline liquidity here. So you have to have a bias and you have to have a narrative for this to work. And all right, guys. So from me, that was it. I guess I pretty much said everything I wanted to say. I will download the recording and upload it. And if anybody wants to ask me any questions right now, just feel free to ask me. But if everything is clear so far, I will just end the recording and upload it. And hopefully this was helpful. So hopefully I could share something useful. All right, guys. Then I'm not sure when we should do the next community call. I just send an update in a group. So that I will send it in a Discord. So right now, last week I've been really busy, but this week I should have more time. So I will just give an update. I'm not sure when we do the next community call. Maybe on the weekend, maybe on Thursday, Friday. But talk soon, guys. So have a great day, and I hope this was helpful. Bye bye.